This morning, the silver price on your screen dropped 43 cents. Yesterday, it dropped another 60. To the casual observer, that looks like weakness. To the retail trader, it feels like relief. Maybe the pressure is easing, maybe the squeeze narrative was wrong. Maybe there's still time. But while the paper price was falling by pennies, the real price of silver jumped by dollars. Not $5, not $10, dozens. While retail investors were watching spot drift from $74.10 down to $73.45, industrial buyers were locking in physical delivery contracts north of $80 per ounce. Some paid $81, others paid $80. And those weren't future maybes. That was immediate, guaranteed, refinery-level metal, wired in cash, shipped under guard, removed from the market permanently. This is the first thing you need to understand. A falling spot price does not mean silver is getting cheaper. It means the paper market is being forced lower while the physical market is being bid higher at the same time. That divergence is not theoretical anymore. It is measurable. It is happening in dollars, not opinions. Retail sees minus 50 cents. Industry sees plus $9. That is the disconnect, and it tells you exactly where the real pressure is. When silver dropped from $75.20 to $73.80 earlier this week, dealer premiums didn't fall. They rose. A 1-ounce coin that cost $79 on Monday cost $82 by Wednesday, even though the spot price was lower. That is not normal market behavior. That is a shortage signal. In a functioning market, falling prices reduce premiums. In a broken market, falling prices increase them because the price you are watching no longer clears supply. This is not a dealer issue. Dealers don't set this. They are reacting to what they are being quoted upstream. And upstream, the numbers are brutal. At the refinery level, 1,000-ounce bars are no longer being offered at spot plus anything. They are being sold at flat prices that ignore the screen entirely. Industrial buyers are not negotiating against futures. They are negotiating against downtime. And downtime costs millions per hour. If you are a semiconductor manufacturer and silver drops from $74 to $72, that saves you nothing. If you cannot secure metal and your line stops, you lose more money in 15 minutes than the entire silver contract costs. That's why these buyers don't care about price drops. They care about possession, so they pay up. That's why the real price went from the low 70s to the low 80s in a matter of days, without the chart reflecting it. This is why you are seeing pre-order only across retail platforms. This is why delivery dates are jumping from weeks to quarters to years. It's not demand from stackers doing this. It's demand from factories pulling supply out of the system before it ever reaches retail hands. The physical pipeline is being intercepted. And the data confirms it. Registered inventory, the metal available for immediate delivery, has been draining at an accelerating pace. Millions of ounces gone in days, not transferred, not reclassified, removed. At the current draw rate, the math is unforgiving. You don't need a model, you just need subtraction. 1 million ounces per day, 20-something million left. You don't need to guess what happens next. And here's the key point most people miss. Every ounce removed now is removed forever. This is not investment demand that comes back when prices rise. This is consumption demand. Once that silver enters industrial inventory, it never returns to a vault. It is cut, plated, embedded, and destroyed as a monetary asset. That's why the price behavior feels wrong. Because the market is splitting into two separate systems. On one side, the paper market is pushing price down by 50 cents, then $1, trying to relieve pressure, trying to trigger selling, trying to convince you that the danger has passed. On the other side, the physical market is screaming scarcity by raising the real transaction price every single day. Paper down, physical up. You can see it clearly now. When silver dipped under $74, retail couldn't buy it for under $80 anywhere. When it dipped under $73, the cheapest physical offers jumped again. That is not coincidence. That is the floor being reset higher while the illusionary ceiling is defended lower. This is what happens right before the break. The system is trying to shake loose inventory from weak hands. It wants you to see red candles and think you're early. It wants you to see price drops and believe supply is loosening. But the opposite is true. Supply is being locked away at higher and higher real prices. The physical bid is rising even as the screen price falls. That is the warning. This is how shortages look in the modern era. Not empty shelves overnight, but widening gaps between what something is priced at and what it can actually be acquired for. If the price drops another $1 tomorrow and premiums jump another $3, that's not bearish. That's confirmation. It means the shortage is intensifying faster than the paper market can contain it. This is the phase where most people get shaken out, not because they're wrong, but because they're watching the wrong signal. The signal is not the candle, it's the premium, it's the delivery date, it's the registered inventory count, it's the industrial bid, and all of those are moving in one direction, up. In next part, we're going to explain why the paper price is being forced lower despite this reality, what happens when that defense fails, and why the next move when it pours to be measured in cents. It will be measured in tens of dollars. Now we have to address the question everyone keeps asking. If the real price of silver is already in the low 80s, if industrial buyers are paying $81, $82, even higher for guaranteed delivery, why does the screen still show $73? Why hasn't the paper price snapped to reality yet? The answer is not supply. It's not demand. It's structure. The paper silver market is dominated by derivatives, and right now that derivative structure is built around one critical level. Call it $75. Above that number, the system breaks. Below it, the system survives another day. This is where the options market comes in. At the $75 strike, there's a massive concentration of open interest. Those options were sold by large institutions, bullion banks, market makers, who collected premium on the assumption that price would remain contained. When they sold those calls, they effectively bet that silver would not sustain a move above that level. That bet is now underwater. As price moves from $70 to $73 to $74, their risk doesn't rise linearly. It rises exponentially. The closer price gets to $75, the faster their losses accelerate. And because of that, they are forced to hedge. This is mechanical, not emotional, not optional. For every incremental dollar silver rises towards $75, their systems must buy futures to neutralize exposure. That buying pressure pushes price higher, which forces more hedging, which pushes price higher again. This is the feedback loop. This is the trap. And this is why the paper market is fighting so hard right now. You can see it in the price action. Silver ticks up to $74.60, then suddenly drops 50 cents in minutes. No news, no volume spike, just a wall of sell orders appearing out of nowhere. 500 contracts, 1,000 contracts. Then silence. That's not selling. That's defense. Those orders are not designed to be filled. They are designed to block. They exist to scare algorithms, trigger stops, and create the illusion of supply. It's called spoofing, and it's the last line of defense before the math takes over. Look at the volume every time this happens. When price drops on thin volume, it's not real liquidation. Real selling is loud. It's heavy. It comes with follow-through. This doesn't. This is the paper market trying to push price down by dollars while the physical market pushes price up by tens. And here's the critical point. They can only do this for so long. Every day they defend $75. More physical metal leaves the system. Every day they push price down from $74 to $73. Industrial buyers step in and lock in another shipment at 82s. The paper defense buys time, but time is exactly what the physical market is running out of. This is why the tension is building. Right? The banks are trapped between two fires. On one side, they have an options book that explodes if price rises. On the other side, they have a physical market that no longer responds to price suppression. The lower they push paper, the faster real metal disappears. That is not a stable equilibrium. At some point, the cost of defending $75 becomes greater than the cost of letting it go. When that happens, the behavior changes instantly. The spoofing stops, the walls vanish, and the price doesn't grind higher, so it gaps. This is what people misunderstand about squeezes. They don't unfold smoothly, they happen in jumps. One moment price is $74.80, the next it's $79, then $83, then $88. Not because buyers suddenly appeared, but because sellers disappeared. And when sellers disappear in a market where physical supply is already gone, price does not discover gradually, it teleports. You've seen this before. Not in silver, but in other assets, where paper promises exceeded deliverable reality. The chart always looks calm right before the vertical move. That calm is not stability, it's tension. Now look at what happens to retail during this phase. Retail sees price drop from $74 to $72.50 and thinks the risk is gone. Some sell, some wait, some plan to buy lower. But when they go to execute, they can't. The metal isn't there. The price on the screen is no longer a price you can transact at. This is where regret forms. Because when price finally breaks through this paper ceiling, it doesn't come back. Not because of hype, but because supply is already gone. There's nothing left to satisfy new demand at old prices. This is why industrial buyers are acting now, not later. They know that once the derivative structure fails, the new price regime sets immediately. They are not trying to time the move. They are trying to avoid being locked out. And that brings us to the final split in the market. On one side, you have paper holders, futures, ETFs, unallocated accounts, instruments that depend on confidence in settlement. On the other side, you have physical holders, metal in hand, metal in private inventory, metal that cannot be rehypothecated. When the divergence becomes undeniable, those two worlds stop converging. Arbitrage fails because delivery fails. And when delivery fails, paper credibility evaporates. This is not a call to action. This is a description of mechanics. In every commodity where this has occurred, the outcome is the same. The paper price becomes irrelevant. The physical price becomes the reference, and anyone still anchored to the screen is forced to reprice overnight. The warning signs are already here. Price drops of 50 cents followed by premium increases of $3. Lower spot prices followed by longer delivery delays. Falling charts alongside rising industrial bids. These are not contradictions. They are confirmations. The system is telling you something very clearly. Silver is no longer being priced for investors. It is being priced for survival. Factories cannot wait. Governments cannot pause mandates. Industrial demand does not care about technical indicators. And when those forces collide with an exhausted supply chain, the result is not volatility, it's revaluation. So where does this leave you? It leaves you with one simple reality. Once the physical market fully decouples, there is no buy the dip. There is only did you secure it before it disappeared. This window does not close gradually. It slams shut. The paper market can hold the line for days, maybe weeks, but it cannot hold it indefinitely while the physical market drains underneath it. At some point, the gamma wall breaks. When it does, the move will not be measured in cents. It will be measured in tens of dollars. And when that happens, the only question that will matter is not what price you paid, but whether you were able to get any at all. Watch the premiums, watch the delivery dates, watch the $75 level. Because when that level fails, the screen price will no longer matter, and the real price will already be gone. If this kind of real supply chain intelligence helps you see what the charts don't, like the video so more people can find it before the data goes silent, subscribe if you want calm, fact-driven breakdowns instead of noise and hype. Share this with someone who's still watching the spot price and missing the real signal. And stay tuned. The next update focuses on what breaks after the paper defense fails.